Stocks see nervous trading ahead of the much-awaited US Fed Reserve meeting, and amidst continued geopolitical tensions in Europe, utilities and energy lead the decline while consumption stocks show resilience.
Mahindra & Mahindra buys out over 17% stake in Swaraj Engines from Kirloskar Industries to make it a subsidiary. The move is a win-win for all businesses.
Triveni Turbine tells CNBC-TV18 that marquee investors along with the promoters have bought a near 22% stake from associate Triveni Engineering as part of a group reorganization. The stock perks up.
Central Bank jumps after it exits RBI's prompt corrective action framework, while a now stronger Yes Bank perks up after its board clears the sale of 48,000 crore rupees of weak assets to JC Flowers ARC.
And SEBI chairperson Madhavi Puri Buch says that the regulator won't allow products that curb exits or exchanges to charge for public data. But SEBI is open to innovations like algos provided there is transparency. Good afternoon. Welcome to Halftime Report. I'm Sonia and with me is Mangalam Malu. Well, things are not looking that good if you're a bull. I guess there's some trepidation as we head into the US Fed meeting. There is, of course, that expectation of 100 basis points rate hike as well. So perhaps some money is being taken off the table ahead of that. The important bit is that banks are really under pressure today, so down over 400 points, and that's leading from the front on the downside. The advanced decline ratio as well, not looking too good. So I guess it's just wait and watch. Everyone knows what's going to come out of the Fed meeting, but the commentary is important, right, as we head into the restrictive monetary policy framework by the Fed. And people maybe don't want to keep their positions open.
That's correct, Sonia. And you know what's happened over the last few minutes or so is that we've been getting some commentary coming in from Putin as well, where we understand that he says that they've announced partial mobilization in Russia to defend the motherland, its sovereignty as well as territorial integrity. And everyone will be eyeing what comes from there, because that's exactly what has further, caused some sort of nervousness to all the bulls, and which has resulted in the kind of decline that we're seeing from the top. Importantly, for the Nifty, if you're looking at levels, the 17,690 level, where the 20-day moving average is the 17,690 to 17,700, this is the support zone. So this is something that we'll be watching out for. If there has to be a bounce, it has to be from these levels itself. But let's talk about individual stocks. Sonia, M&M has proposed to buy, what, 17.5% stake in Swaraj Engines?
Yes, and there are three companies in question here, right? There's M&M, there's Swaraj Engines, and there's Kirloskar Industries. All three are listed. Now, let me start with Swaraj Engines because it's the biggest mover today. It's up almost about 12%. Now, M&M has proposed to buy an additional 17.4% stake in Swaraj Engines, which means that M&M's stake in Swaraj Engines will now rise to 52.1%. So it will now become a majority-owned subsidiary of M&M. This means M&M will take complete control of Swaraj Engines in terms of the working, etc. And that's a big positive for Swaraj Engines. As we know, Swaraj Engines manufactures diesel engines for M&M tractors, and they've been doing it for years. The earnings have been pretty good. In the year gone by, the revenues went up 15.5%, and in the last 3 years, it's been a very healthy growth. So just the fact that M&M will be taking over entirely is a big positive for Swaraj Engines. Now, Kirloskar Industries is the other one that we're looking at. It's the holding company of the Kirloskar Group, so there's a holding company discount as well. Now, Kirloskar Industries will get about 300 crores for a market cap of 1,600 crores, so there's a big positive over there. And they were, of course, they are the holding company, so that stock is up about 5%. But on M&M, I do want to mention that M&M has been making all the right noises, whether it is focusing on the core business tractors and autos, whether it's getting rid of some of their legacy non-core businesses. Increasing stake in Swaraj Engines not only gives them more control, but they're also focusing on not just growing the top line, but reinventing the cost structure. So perhaps they will be cutting down more costs in their farm equipment business. In any case, the market share game, they're gaining over there. So they've gained almost 1% in the quarter gone by. The domestic volumes were the highest ever in the tractor business at 112,000 units. It was a growth of 18% in the quarter gone by. And M&M is very confident of 7 to 8% compounded growth rate for the tractor industry over the next 7 years. So all the right noises. It's a win-win for all three companies. And of course, the one that benefits the most is Swaraj Engines, because now it becomes a subsidiary of M&M.
Yes, and as you speak, Swaraj Engines is the stock which is gaining the most as well of the three that we're talking about. Let's focus on another big story Triveni turbine is up more than 3% as nearly 22% equity changed hands today. Vivek Iyer joins in with the details. Vivek, we had the management speak to us today as well.
Well, absolutely right. So what we were tracking is the fact that, Triveni Engineering and Triveni Turbine, there was quite a bit of cross-holding. In fact, Triveni Engineering at the end of the previous quarter held 21.85% stake, and the company, had actually gone ahead and given the nod to divest the entire stake. So along expected lines in today's block deal window, there were, two large blocks that took place. The first block was a 10% exchange where Triveni Turbine promoters bought almost 10% of a stake of their own company from Triveni Engineering. The more interesting part, of course, is the remaining 11.85%, which, the management of Triveni Turbine themselves told us in an interaction that, this particular stake was picked up by very large sovereign wealth funds from Abu Dhabi. We also understand that a California-based fund has picked up stake, and also very large domestic institutional mutual funds have picked up stake. Mainly, this particular deal was done in order to ensure, a realignment as far as the focus of Triveni Engineering as well as Triveni Turbine's management was concerned. And, what we understand is that going forward, we can expect more inter-se promoter transfer so that, both of the brothers of the Triveni group will get complete operational freedom as far as Triveni Engineering and Triveni Turbine is concerned.
Okay, in fact, thanks a lot for that. We had a chance to speak with Nikhil Sani, who's the Vice Chairman and Managing Director of Triveni Turbines. He confirmed to CNBC-TV18 that the promoters have bought stake in the block deal. Listen into what he had to say.
We're very proud that we have, and I believe very marquee investors, many sovereign wealth funds and large international institutional investors, as well as very large mutual funds. And I think that we have, I believe, extremely quality investors. This was, of course, as you alluded to, a divestiture from the engineering side, where they sold 21.8%, I think, for approximately 1,600 crores. And we at Triveni Turbine are extremely proud of the fact that we've been able to actually expand the float of the stock, as well as the promoters itself have also bought 10% of that block. The ultimate plan, as I am the Vice Chairman and Managing Director of Triveni Turbine and my brother is the Vice Chairman and Managing Director of Triveni Engineering, it would be for majority shareholding to reside with the operational executives of that business from a family perspective. As you rightly pointed out, the principal promoters are my father, my brother and myself. And as my father's plans his succession, it will logically fall to the sibling that is operationally in charge of that business.
All right, so that's about Triveni Engineering and Triveni Turbines. The other stock on our radar is SpiceJet, and that's under pressure on the back of its recent cost-cutting measures. Sonia, it's been under a lot of pressure over the last few months or so.
Absolutely, and the balance sheet is severely stretched, right, as we know. Now, the latest is that SpiceJet has asked 80 pilots to go on leave without pay for the next 3 months. And although this comes as a drastic move, SpiceJet says that it was needed to be done in order to cut costs. There's no recapitalization plan in place just yet. Hence, the need of the hour is fundraising, which has not happened. So that's putting pressure on the balance sheet. Just look at the way the profit and loss situation has panned out. From a profit of 500 crores in FY18, they are now staring at a loss of over 1,700 crores as of FY22. And it's been problems galore for the last many months, as you pointed out. The company has delayed salaries for the second straight month in August. Recently, their CFO resigned on the 31st of August. The auditor has said that the recent result that the company posted has cast significant doubts about the company's ability to continue as a going concern. That's because the accumulated losses of SpiceJet are now more than 5,900 crores. Not just that, even on the operational front, 2 more of their Boeing 737s were deregistered by the DGCA. So the problems are just piling up. And now the latest addition is that they have asked 80 pilots to go on leave without pay for 3 months. Just goes to show how severe the stress is on the books.
Take that point, absolutely. And when it rains bad news on aviation companies, it definitely keeps pouring as far as these news pieces are concerned, and under pressure on SpiceJet. The other stock which is doing well in today's trading session is Central Bank of India, and this is after the RBI has removed the bank from its prompt corrective action framework. Ritu Singh joins in to tell us more. Ritu, now that this has gone, the company can go ahead and expand their branches.
That's right, the RBI has finally removed Central Bank of India from the Prompt Corrective Action Framework after more than 5 years. And this makes Central Bank one of the last banks to be taken out of the PCA framework after Indian Overseas Bank and UCO Bank were removed from PCA just last year. Now, RBI in a statement said it reviewed the performance of the bank and found that it was no longer in breach of the PCA parameters. Remember, Central Bank of India was placed under restrictions in June of 2017 because of its high net NPAs and negative return on assets at the time. Since then, the bank's performance has seen an improvement, although its gross NPAs remain high at almost 14.9% as of the last reported numbers. Its net NPA, which is what RBI looks at, has fallen to 3.93% as of the June quarter, compared to 10.2% in March of 2017 when the bank was placed under restrictions. Its capital adequacy ratio has also improved from 10.95% at the time to now at about 13.3%. Under the Prompt Corrective Action Framework, Central Bank of India had restrictions on dividend distribution, on the management compensation, branch expansion, and so on. And now the removal from PCA paves the way for normal functioning of the bank.
Okay, thanks a lot for that. Well, earlier today we spoke with M.V. Rao, who's the MD and CEO of Central Bank of India. Listen in to what he had to say about this important development.
We will be coming out of the PCA because the measures what we have taken, and we know that it is only a matter of time, and also the confidence what regulator will be getting on our activities. That's why we have factored all these things when we have given these projections. I tell you, our gross NPA will be drastically coming down. The slippages what we are envisioning for the quarter of September will be around 1, not more than that. We have given the graded gliding path where from 3.93 we will be touching around 3.6, 3.55. In that range we have given.
Well, sticking with the banking theme itself, Yes Bank perks up in trade after its board has cleared the sale of its nearly 50,000 crore rupees worth weak assets to JC Flowers ARC. Ritu joins us back again on Yes Bank this time. Ritu.
That's right. As we reported earlier, Yes Bank has now said that it received no challenger bids to the 11,183 crore rupee offer made by JC Flowers ARC to acquire its 48,000 crore rupee NPA portfolio. And therefore, in its meeting on the 20th of September, the board of Yes Bank has approved the declaration of JC Flowers ARC as the winning bidder. And separately, they've also approved the acquisition of up to 19.99% stake of Yes Bank into JC Flowers ARC in single or multiple tranches. But importantly, this acquisition of stake in the ARC is going to be subject to regulatory, specifically RBI approvals. So we'll have to see how that pans out. However, for the transfer of the NPA to the ARC, no other regulatory approvals are required. So this paves the way for cleaning up of Yes Bank's balance sheet. In another important development, Yes Bank said that the Reserve Bank of India has approved the appointment of R. Gandhi as the chairman of Yes Bank for a period of 3 years. Remember, R. Gandhi, who was a former RBI deputy governor, was also on the board of Yes Bank for 2 years during the period of reconstruction of the bank. And now with the newly appointed 9-member board, R. Gandhi is set to take over as the chairman for the next 3 years.
All right, Ritu, thanks a lot for that. So that was the CNBC TV18 news break confirmed. With that, we'll take a short break. On the other side, we get chatting with the management of MapmyIndia. Remember, yesterday around this time itself, the company did, announce its Mapples application for the logistics platform. Let's discuss more on this with Rohan Verma.
Welcome back to Halftime Report. So MapmyIndia, which is a homegrown digital maps and deep technology company, has unveiled Mapples, which is an app, logistics solutions for the enterprises. Now, Mapples is integrated with the Government of India's ULIP to discuss this opportunity size and the business outlook. Rohan Verma, who's the CEO and Executive Director of MapmyIndia, joins in now. Rohan, thanks a lot for joining us. If you can just start by telling us, what is the opportunity size that Mapples has? How many enterprises you think would use it eventually? And have you had any discussions or conversations?
Thanks a lot, Sonia, for having me. See, there are 280 million vehicles, many of them involved in fleet logistics across the country. And almost all of them can benefit from MapmyIndia's digitization technologies, which can help them help digitize and optimize logistics. So this really is a multi-billion-dollar opportunity, and this is one of the reasons why we had bought the IoT and logistics SaaS company G-Tropy in January. And if you look at it from the government's point of view, the stated mission is 14% of GDP is the cost of logistics. Today, it has to be brought down to single digits, 8 or 9%. So 5% of GDP is the amount of value that can be created, and a lot of that can be driven by technology, and that's squarely where MapmyIndia is playing in. So very, very large opportunity for us in the logistics sector, providing our technology.
Right. We understand that, Rohan, you spoke about being integrated with the ULIP, which is the Unified Logistics Interface Platform, which was announced as part of the National Logistics Policy, which would consolidate all the various government angles that are there in this to make things simple for people. What we try to understand here about Sonia and me is, is yours the only solution in the market? What's this benefit that you get by integrating with ULIP? Is there a revenue share model with the government? What exactly, exactly does this work?
Yeah, see, the simple use case that was shown to the Prime Minister also, amongst the many things, was track your transport. So every logistics stakeholder, whether the shipper or the receiver or even the vehicle owner, wants to know where the good is in real time, because that's how they can plan inventory, expected time of arrival, etc. Now, ULIP, by integrating MapmyIndia's APIs, is able to show that on the Pan-India map using us. ULIP's business model is being discussed and finalized by the government themselves. And as a result of that, we will also get some commercial benefit from that specific use case of ULIP. So we are not the only technology provider that exists in the logistics sector, but definitely we are one of the most advanced and largest providers. So we can ride this increased accelerated wave of digitization that is coming in the logistics sector with a pretty comprehensive set of offerings. If people look at our offerings, they will find that any logistics
No, just trying to understand what would the sort of revenue potential be, any kind of revenue sharing model between the government and you. If you can put some numbers to this.
Like I said, the business model for ULIP is being finalized by the government. I'll let them kind of take the lead on kind of announcing that, we will follow from there. But outside of that, like I said, outside of ULIP, outside of government, we get per vehicle per month. There are per API transactions, per use case. This is kind of MapmyIndia's standard business model applied to this very, very large and growing vertical of logistics.
Right. So we'll talk about that when we come to it. But Rohan, the last 2.5 months, we're towards the end of the second quarter itself. Can you tell us what's the kind of key wins that you've had in terms of clients? At the same time, you've also invested in an auto startup called Navgati, about $4 million. What's the rationale behind that?
I'll talk about key wins first. Key wins are, again, across segments. So whether it is, the smart city police departments, or state road transport corporations, or footwear companies, or tech, social media kind of apps, or of course in the automotive sector, you saw the new MG Hector and MG Gloucester being talked about with our maps and technologies. So the momentum of wins continues, and the different types of use cases, including, let's say, drone-based solutions for mapping out rural properties, the momentum of wins continue. Just on Navgati, it's actually quite a small investment. It's 1 crore, from our side. It's an interesting company on the oil and gas vertical SaaS sector. They provide solutions for congestion monitoring and compliance monitoring based on video analytics and IoT for oil and gas, fuel stations, CNG pumps, etc. It's complementary in the sense that we can find a partner to go deeper into oil and gas vertical, because that's generally MapmyIndia's strategy, that our horizontal platforms, maps and technologies applied to one industry at a time gives us headway to grow more in each sector and penetrate that market deeper with the number of clients that exist in that space. So we're expecting more oil and gas vertical penetration for us in the time to come with the help of Navgati, together with them.
Okay. You do have a little under 400 crores on your books in terms of cash. How do you plan to use that?
Sonia, so mix of organic and inorganic. Okay. Organic means expanding our own product portfolio, enhancing that, expanding our market presence and reach, including international. So that's organic. And inorganic is things like Navgati, things like other kind of acquisitions or investments that we look at from time to time based on the synergy and addressable market opportunity that it affords to us. So mix of organic and inorganic.
Rohan, final question from my end. Then, there have been instances of inaccuracies in the product that you have as well. And, it's across the board. I mean, you see it from the international competition that you have as well. But my point is that, you spoke about the national logistics policy and how that benefits you. But a broad, perspective of that policy is also to increase exports and simplify exports. So to that extent, how does your product integrate with global shipping companies? What's your kind of strength in maps outside of India? That's point number one. And secondly, what are you doing to get to the B2C place? Because currently you're just B2B and B2B2C if you must. There's no direct B2C play out here for you.
Yeah, great questions. So, on the first point of, let me answer the B2C and B2B2C point first. And at the second question on the maps, see, we have integrated maps for 200 other countries into our solution. So now we are not just an India only solution, we're a global solution provider to any company or organization for any country. Now, the interesting thing around logistics and the consumer app, and this is what differentiates us from typical B2C players that we are all used to. Now, using MapmyIndia's Mapples app, a truck driver can see what the cheapest route is, including toll and trip costs based on the vehicle type and fuel mileage. He can see rest stops. A two-wheeler rider can get the exact directions to a house number so that he doesn't have to call the person and ask them, now I've reached nearby, where do I come? So logistics becomes simpler from the end user point of view. Plus, our our platform allows for logistics optimization at the back end, IoT for fleet management, multimodal route optimization. This is quite a unique combination of B2C app plus B2B and B2B2C platform so that we can solve logistics, transportation, road safety in a more comprehensive way. And I think over time, as we start advertising and promoting our consumer app, more and more people will realize that not just can it help them in their daily life as a consumer, but the backend systems that we have integrated with the government systems as well as their enterprise systems gives a holistic technology solution to really transform the country. That's what we are really excited about.
That point, Rohan. Yeah, we understand that point. Yours is a more comprehensive product, etc., for local markets, tailor-made to truck drivers and two-wheelers, etc. In 2013, there was one app which did extremely well, and it was competing against Google. That's Waze. Google went ahead and bought it for $1.3 billion. Do you think that's a possibility here as well? Because there's a good local app, there's comprehensive solutions that you guys are giving, and then there comes a global player with a lot of money. Are you open to something like that?
We are very excited about what we plan to do for the consumer side. I would just say, keep an eye out. We've been building a war chest. I think people are appreciating the unique features of the app. There is stuff that we intend to do on the consumer side. Definitely, good question, and it's something that will unfold in the time to come.
Will you sell to Google?
No. We built a 27-year-old strong business, very, very focused on Atmanirbhar Bharat. I think we are far better, far superior in this mapping space. We intend to be a very strong, independent company. I think, the world is our oyster. It's really our execution. And we really want India to have very strong indigenous deep tech products and platforms company whose technology can be exported globally. Why should we have to be worried about being bought? We can grow into something very large.
Okay, all the best for that. Thanks a lot for joining in. That's MapmyIndia with their latest Mapples consumer app. We'll slip into a quick break. On the other side, we'll put focus on what we can expect from Jerome Powell's commentary later tonight. Do stay tuned in.
Welcome back. Even as the market slips lower, we have the India VIX, which has spiked about 9% to the high point of trade. And the key reason for that is that all eyes are on the Fed decision tonight. Jerome Powell's commentary is something that we'll be watching out for more closely than just the rate action that they are going to do. The September CNBC Fed Survey shows that on average, respondents believe that a 75 basis points hike is imminent, bringing the federal funds rate to about 3.1%. Respondents also believe that they will remain at peak rate for nearly 11 months. CNBC's Steve Leisman gets us a quick wrap of the survey and highlights.
Wall Street increasingly embracing the idea that the Fed is going to hike and hold at a restrictive rate rather than the old idea, which was that it would stop short and then cut quickly. The September CNBC Fed Survey finding that 75 basis points is the call for this week. All of our 35 respondents, except for two, who put it at 100, but mostly saying 75. Then that peak rate, the terminal rate, 4.26 now. And that is 40 basis points higher than the July survey. That peak rate is hit in March of 2023. Then the important question we asked this time, how long will the Fed hold there? 11 months is the number, with some saying as few as 3, some saying as many as 24. The recession risk now 52%, little changed in the next 12 months, by the way, little change from the prior survey. John Riding writes, the Fed has finally realized the seriousness of the inflation problem and has pivoted to messaging a positive real policy rate for an extended period of time. That's the important part there. So there's the trajectory. 240 right now, 238, call it. We reach near 4% by the end of this year, go up to that peak rate in March. And then you can see that there is some cuts built in. That's the result of some thinking the Fed turns tail quickly. But the average, again, thinking the Fed stays there and holds, with cuts coming perhaps into 2024. Rates stay high because the 35 respondents think that it takes a long time for the Fed to bring down inflation to its 2% target. We're 8.3 now. We go to 6.8 on the CPI by the end of the year, 3.6 by the end of 2023. It isn't until 2024. Just 60% believe the Fed hits the 2% target. By the way, more than 80% of respondents did not change their inflation forecast over the next 2 years because of the Inflation Reduction Act. Along with the recession risk comes an expected rise in unemployment. Take a look here, what's expected to happen. You're at 3.7 now. Go to 3.8. Not too much damage by the end of this year, but next year, 4.4. It's still an historically low rate, but you often don't see a 1 percentage point increase from the bottom outside of a recession. While these respondents have argued over the past several months that the Fed was way behind the curve in tightening policy, many also now are concerned about the opposite, that it will go too far or further than it needs to go.
Okay, on that note, here's some opinion on the likely Fed decision and its implications from former Fed officials and market experts. Listen in.
If the Fed surprises the markets and goes 100 basis points, that suggests they're much more worried than we think they are, and I think that would cause a lot of tumult. But I think it's pretty clear that they'll go 75. I don't really see why they would need to move 100 basis points. I don't think they were that surprised that the core inflation numbers were not coming down, because rents are such an important driver of that, and rents are lagging. I think they will start to grow at a lower pace, but not yet.
I think they probably recognize the necessity, and they've said this many times, the necessity of the economy slowing if they're going to get a handle on inflation. And I think the Fed has been, Jay Powell has been steadfast at least since August, about the importance of the Fed regaining its grip on inflation. That's good news. I'm glad to hear that. And other FOMC members have been saying the same thing. I wonder sometimes where that commitment was a year and a half ago when it should have been in presence, but it hasn't been. So I think they're pretty steadfast. They're not concerned about a slowing of the economy at this point. Will they escape a recession? That's hard to tell yet.
I mean, the bottom line is we want to see inflation brought under control. I mean, I think that's what all global markets are focused on. And I think what's also clear is we think in terms of financial conditions, and financial conditions probably need to get tighter to accomplish that goal. This summer, after we already had rate hikes, financial conditions actually loosened in August. I think, Chair Powell's Jackson Hole speech and the CPI print in the U.S. Last week confirm that we do need tighter financial conditions. So you could say it's a bit of a painful medicine, but it's a necessary one to bring inflation under control. I think all global markets are keying off of U.S. rates at the current moment.
Okay, well, our own markets are also under pressure now ahead of the Fed meeting. So just take a look at the Nifty. The chart is down about 150 points. That's a 1% cut and at the lowest point of trade. We'll tell you how to approach the markets on the other side of the break. Sachidanand Uttekar will be joining in with some trading strategies. Stay tuned.
Welcome back. We're at the low point for our indices. The Nifty Bank is down over 500 points right now. More than just the Fed, I think, some commentary coming in from Russia has also added a wee bit of volatility to our market, maybe some sort of nervousness in sentiment, and that's reflective in the kind of moves that we're seeing in the Russian index itself. The Russian index opened with a cut of almost 8.5 odd percent, and currently as we speak, the MOEX is down by almost 5.5, 6 odd percent, and that's caused a bit of flutter in our markets as well. Global markets are seeing a wee bit of risk on as we speak. Good time to get in Sachidanand Uttekar for a quick check on the technicals of the market. Sachidanand, we've so far managed to hold the 20-day moving average despite the declines that we're seeing from the top. Even after the decline that we saw on Friday, Monday, Tuesday, we recovered. What are your thoughts on where we go from here, given the increased volatility in global sentiment?
Good afternoon, Mangalam. Mangalam, I think if you specifically look at today's trading session, it looks more on because of the unwinding pressure that we have seen so far. If you look at the levels, I think the 17,680 is a very significant level as the 20-day moving exponential moving average is placed there. But if you look at the data set, it is clearly exhibiting that Nifty should be range bound. 17,800 looks like a resistance as of now. But on the lower side, we don't see it slipping below 17,600. So probably the idea is to continue on the short side on the market as of now, keeping a stop loss somewhere close to 17,740 on the higher side. And probably during the day, we may see another swing towards 17,600. I think that will be a good level to re-enter into the market from a long perspective. When we look at Bank Nifty, the put call ratio has come down to 0.7. But despite of that, there is still some room on the lower side. So I think the reward to risk opportunity in Bank Nifty is far more better than Nifty. We are expecting that this particular swing could continue towards 40,600 on the lower side. The stop loss should be placed at 41,160 on the higher side, and fresh shorts can be deployed in Bank Nifty as of now. But Nifty, I think the reward to risk is not that prominent.
Okay, I wanted to ask you about the Adani Group stocks. After many days, we're seeing a massive slide in these names, of 5 to 6% lower. Now, Adani Ports is down about 5%. Any thoughts on how to approach it from a trading perspective?
Well, good afternoon, Sonia. Sonia, if I look at Adani Enterprises itself, I don't think, since last June 2022, we have seen the stock sustaining below its 5-day exponential moving average. And today is the first time wherein we are seeing that particular, phenomena getting established. So probably one should, book some profits here. If you look at, both the monthly as well as the daily scale, the RSI is clearly in an overbought zone, an extreme overbought zone. So probably some profit booking is evident. So I would refrain from building any fresh long positions when it comes to Adani Enterprises per se. Probably a good level could be around 3460, 3450, where its 20-day exponential moving average is placed. So as of now, I think it's better to avoid any fresh trades on either side of this particular counter.
Would you have any support levels for cement stocks? ACC, for instance, is now down, 7%. After having seen a bit of a rally, it's turned negative for the week. We have India Cements, which is down 6%, along with Ambuja as well, which had seen a big rally, right now down a lot, almost 6.5 odd percent. A view on these stocks, along with the stocks that you've lined up for us today?
Mangalam, I think cement stocks are clearly in a very strong bull trend, and probably if you look at ACC per se, it has moved back towards its 20-day exponential moving average. So I think that will be a good support. Somewhere close to 2500 would be a good idea, good level to get into this particular counter. We are not seeing any major distortion of the trend, so it's a good healthy trend wherein buy on decline should be adhered. The stop loss should be placed at around 2420 on a closing basis, and probably we may see it again swinging back towards 2700. As far as trades are concerned, I think it's better to keep a long-short ratio here. Clearly, the FMCG pack has been buzzing, and here HUL has broken out from a declining wedge formation, which is a very strong indication of a reversal. We are expecting this particular momentum to continue towards 2680. So we still believe that this particular counter should be accumulated on a decline. The stop loss should be placed at 2595 for HUL, and long position should be built here. On the other hand, Tata Motors is one particular counter which has been a relative weakest counter when we look at autos. So if you look at the data set here, clearly it has been failing to sustain above its 200-day exponential moving average. On the 60-minute scale, there's a clear-cut bearish pennant formation indicating a price target close to 405. So probably fresh shorts can be deployed here on Tata Motors with a stop loss at 435.
Okay, thanks a lot, Sachidanand. Have a great day. That's the word coming in from Trade Bulls. Let's slip into a quick break. Before we do that, here's some great news for investors. You can now track US market action real time on Money Control. Log on to the Money Control website or the app and stay informed about all that matters in global markets.
Well, in an otherwise weak market, one stock which is actually doing well and spiked post the management's conversation with CNBC TV18 here is AkzoNobel. For consumers, you can think of this as the company that sells paints under the brand Dulux. Importantly, the three things that the management said to us and the reason why the stock has moved higher. The first one, of course, is that by fourth quarter, the margins for the company will be back between 15 to 17% range. And this as against 13% that they had done in the first quarter itself. They will increase their ad spends and they target to be the number 3 player in the paint industry versus number 4 that they are. And what does that imply? Well, if you just take a look at the paint industry revenues, Kansai Nerolac is close to around 6,400 crores at number 3, whereas AkzoNobel is at around 3,100 crores. So if they're targeting to be number 3, then the revenues could perhaps double from here itself. And at 24 times, it is also the stock which is at the lowest valuation in the paint sector itself. So let's go across to the management bites. Yeah, please.
Before that, I don't know why I know this, but Dulux, the name comes from DuPont, the technology that they use, and luxury paints. So they put that together and they formed Dulux. I don't know why. I mean, these are certain things that just kind of stay with you, right?
Yes, they do. And what stays with me is the Dulux, jingle.
The ad. Dulux. Okay. I think we know too much about
We know a little too much. Let's go across to Rajiv Rajgopal, who's the managing director. He spoke with us, and this is what he had to say.
I still maintain that it will take a couple of more quarters to really see the softening in coming in really accretive from a margin perspective and from a P&L perspective. As and when we start seeing the margin pressures cool off, you would start seeing an improvement in the industrial segments. That said, I think on the industrial segments, what is most encouraging is the sort of growth that we are seeing. And we are not seeing it now. We've been seeing it for quite a number of quarters. And what I love about the growth is that it's very uniform. I mean, we don't give specific numbers in terms of volumes, etc., the way we are. But suffice to say that we are looking at strong double-digit growth. What do we give targets on? Our intent is now to start really being material in the industry and really start being in the top 3 in terms of growth.
Okay, that's Axo Noble. Let's slip into a quick break. On the other side, Manisha Gupta will join in with PR Somasundaram of the World Gold Council. Stay tuned.
Welcome back, and joining us on the show now is Mr. PR Somasundaram. He is Regional CEO India at World Gold Council. Som, hi, good to have you as always. You know, the US Fed meeting, and ahead of that, we have seen various asset classes see a bit of a decline. But gold and silver seem to be getting hit the most because there is a lot of correlation that people try to read in with the interest rate hikes, the US dollar movement, and gold as well. Would you say that 75 basis point of a rate hike has been factored in now, and it majorly is going to be about what US Fed does in November, December? That really seems to be bothering the space.
Yes, exactly. Gold is already down 7.5% since the beginning of the year. And the hike of 75 basis seems to have been factored in, and nobody expects anything lower than that. But what happens will be what is the forward-looking statements they make about further rate increases or about other aspects of the economy. That will be clearly watched. So yes, gold as of now is facing severe headwinds.
Oh, yes, it is. So, you know, when you look back at the year until now, the first 3 quarters of this year, and we've done a range of 2,050 to 1,650 already. What is your sense on how the last quarter of this year would look like? And are we near the bottom, really?
It's very difficult to say because then, you could really, if you know that, you would be taking very strong positions on that. And also, we don't forecast the prices, as you know. What I can say is clearly the fourth quarter and what's happening to the gold price is going to be very, very good for demand. It's already below 50,000 and we are entering the season. So when it comes to the Indian demand, I think we should watch out for a big spike.
Oh, well, absolutely. With prices especially below 50,000 rupees, I think it's very lucrative levels to start buying here. Also, talk to us about the dollar index and the impact on gold, because we are right now trading at a new 20-year highs at 110.79 in sense of dollar index.
Yes, while the dollar price, as you see, has been affected, you can't say the same about the gold price in other currencies. There is obviously every central bank is trying to increase the rates. So it will certainly soften in all the currencies, but not the difference between the fall in dollar price and the fall in other prices are not synchronized.
Right.
You know, it will be far, far lower in other currencies because against the dollars, even those currencies are not doing very well. Clearly, whether this dollar index strength will hold out is all, questions that economists will answer, and we will see as the market moves on with other news. At the moment, clearly, as one can say that this seems to be the trend, and in the very, very short run, you don't see much of a support for gold.
Okay. So when you say that, are you looking at 1,600 breaking? Because, so I know you don't predict prices here, but there are so many reports out there. And yes, most of them talking about how the prices can stay below 1,700 for the fourth quarter as well. But what are you reading? What are you hearing? What are people saying on, is 1,608, or do you think prices can go further below?
Look, gold could remain under pressure because if central banks continue to raise aggressively, and as I said, we should also look out for the forward-looking statements they're going to make about the economy. But then there is also the risk of stagflation. There's a risk of outright recession. How market reads these developments, how market reads the probability of these really happening is going to be a supportive factor. So you can't really say it will be one way based on the rate hikes. At the moment, the overwhelming influence is obviously the monetary policy, but there are other factors which probably are beyond the control of monetary policy. That will probably aid gold. So it is very difficult to say whether it will be one way down.
Okay.
After the rate increase, particularly, we have always seen the space to do further increases comes down. Therefore, you could also see that the market, bounces back, saying that, oh, it's happened. Now, can there be another 75 basis? It will have a severe impact on various other aspects.
Right.
So that might be very positive for gold. So it's very difficult for me to say, Manisha.
All right. Take that point, Mrs. Somasundaram and Manisha. Thank you so much for joining in and talking about gold and the fact that there could perhaps be some more downside from here itself. We wrap up on this edition of Halftime Report on that note. Business Lunch takes all the action ahead.